One thing that often comes up in client conversations is whether or not to hold employer stock. It's understandable to want to keep company shares. I've always had a connection to the work I do. That's why I chose to work at T-Mobile, Amazon, and other companies. I felt real ownership. There's also internal marketing. The restricted stock and stock purchase emails are super positive. When the stock was up, a graph of the stock's performance was usually presented at our all-employee meetings. For some reason, it wasn't featured as often when the stock was down. However, there are three primary reasons holding employer stock might be less than ideal. First, an employee already has a lot riding on the company. Employment is often the biggest driver of wealth creation. Unfortunately, it only takes one person, their supervisor, to decide they're not performing and they're out of a job. Their position may also be eliminated if their team or department is laid off. When are terminations most likely? When the company's not doing well. Public companies also have an outsized impact on the local economy. The value of real estate and small businesses depend on the health of these big local employers. Being overextended in a company stock could cause a quadruple whammy. The stock price might fall, the employee might lose their job, their home value may drop, and their spouse might also lose their job. Unfortunately, I saw that. A billion-dollar retailer went out of business in a town of less than 10,000 people. To say it impacted the local economy is putting it mildly. I call this the contagion effect. Second, employer stock has greater risk than the overall market. Single stock risk is the chance something happens to one company. A major competitor enters our space. A key executive retires or performs poorly. Someone cooks the books, etc. These risks are reduced by holding a bunch of smaller investments instead of one huge one. That's diversification. But my company's different. I've worked with coworkers and clients at many companies. Employees always seem to think their company is special. On average, they're average. Someone can reasonably expect average returns for their company. An investment with an average return and above average risk is a poor investment. Finally, employees are often rewarded for company performance through bonuses, restricted stock units, stock options, stock grants, discounted stock purchases, and the like. These programs offer significant upside if the company does well. I hope this helps. For more content, subscribe to the Scale Finance YouTube channel or check out the Insights page on scalefinance.com. Thanks for watching.